What is going on, investors? Hopefully, you guys are doing well out there. Time to grab your Mocha Venti latte, and it's time to talk about Starbucks Corporation, ticker symbol SBUX. And I'm particularly interested in this one since I've actually owned shares of Starbucks. I had to go back and look in my IRA account. I've owned this one back I think I started buying it in this 2016, 2017 sideways consolidation. And I'm wondering if we're going to be doing a complete round trip on Starbucks and retest those levels down at closer to $55 per share. We'll discuss that. We can do a large deep dive into shares of Starbucks because I think it is warranted. The company announced their Q2 earnings and they were nothing short of a disaster. At the time of announcement, Starbucks shares were closer to $90 per share, and then they fell off a waterfall and are now close to $73 per share. That's despite revenue declining just 1.8%. But I tell you what, that outlook and the guidance was an absolute disaster. Also, we'll go through the conference call at Starbucks. I tell you what, when you have this dramatic shift in business and demand and focus for a company, it's important to go through the conference call. Talk about some of the innovation changes the company has going on, some of the key things that were said, some of the turnaround plans at least in place right now from management. Then we'll come over here and look at the financials as well. And then, the stock chart. Are we going to round trip back to 50? Can you buy the dip now, or should you wait? Now, those revenues, like we said, coming in at $8.56 billion. That was a big decline year over year, basically seeing weak demand going forward. Analysts haven't completely revised their revenue estimates going forward, so you got to expect over the next week or so, these are probably going to go weaker. Are we really going to do a December quarter where we put up 7% growth, $10 billion in revenue? Maybe, as the company continues to launch new drinks, which seem well received. Now, one of the problems that the company noted is they have this mobile order and pay system, their mobile app, the Starbucks app, which is relatively popular, especially with people that regularly frequent Starbucks. And they said, in other words, customers using that mobile order pay system put items into their cart and sometimes chose to not complete their order, citing long wait times of a product availability, and the company recognizes this as an opportunity. So what they saw was customers would open up their Starbucks app, put in their order, but then see that maybe sometimes some of the products that they wanted aren't available, or that the wait times were going to be longer than expected. So the company is going to roll out what they call a siren system. And this young lady is demonstrating it. It's a new way to make the drinks. It reduces the number of steps. It speeds up the process. It allows the barista to not have to move as much, and it increases the speed and allows maybe solving some of the problems that they have here with product availability and wait times. It'll solve a little bit of that. And the company announced that in the stores that they've used this Siren Craft system to optimize operations, they've already seen an increase of throughput. And here's what's interesting. We estimate it worth nearly 1 comp point annually. So you'll increase 1 percentage point of comp sales annually once they install this type of system inside the shops. Now, they only have about 10% of stores operating there. And one analyst on the conference call said, hey, you announced this siren system years ago. It was actually 2 or 3 years ago they announced this. And he said, hey, you kind of put it on the back burner. And the executives kind of shot back at that. But I've got to agree, if you had this idea several years ago and you're just now kind of getting serious about it, it definitely was on the back burner, but this could be some innovation coming to Starbucks relatively soon, and that could, again, increase the throughput and reduce some of the things that they're seeing as it relates to wait time and availability of the product. Now, company is also trying to address new markets, which they are seeing as serving customers overnight between 5 p.m. and 5 a.m. Maybe those workers that have night shifts and those types of things. They say historically their stores are closed, but they did a pilot test and they are doubling their business. And they believe this overnight business could pursue and build into an over $2 billion business over the next 5 years. And when we get to the financials, a company doing $8.5 billion worth of revenue in a quarter, $2 billion, not necessarily a rounding error, but certainly could be tangible if that overnight business increases. And it's some area of business where you might have less competition. And that is something also Starbucks is facing. Now, what was a very, very strong question from one of the analysts that says that Starbucks had an analyst day back in October and early November. And they said at the time, Starbucks did, demand was not a problem here in the United States. And so the analyst was wondering how quickly, just 4 or 5 months later, Starbucks had very ambitious goals and very ambitious demand goals, and all of those have been wiped out the window in the most recent quarter. And they said, well, how could you have been so bullish in October and November, and now earnings and revenue and guidance is completely fallen off the map? And I guess if you believe Starbucks at face value, that demand here in the United States and the consumer in particular has just completely fallen apart, and they're trading down. They're not buying $5 cups of coffee. They're brewing it at home. They're trading off to other brands. They're trading off and making that sacrifice. Probably some of that is true, but also probably Starbucks is to blame as well. Maybe you've had some brand deterioration, competition, all of those things probably playing a role. And so I don't think it's going to be as simple as the consumer just gets more healthy. That's something that could last a particularly long time. And I think no matter what Starbucks problem, there simply is not going to be a quick fix to have a solution. Your total net revenues come from 8.7 all the way down to $8.6 billion. Now, what they did see is their product and distribution costs did tick down along with the revenue side. So you like to see that. You wouldn't like to spend more on product as you had declining revenues. They did notice in the conference call that some products and their cost is starting to get reduced. That's good for inflation and certainly customers of Starbucks as well. Unfortunately, your operating costs continue to rise over the last year as wages and those types of things continue to move higher. Other expenses basically ticking up, and you see your total operating expenses basically flat year over year. So with declining revenue and flat expenses, your operating income took a big hit from 1.3 last year all the way down to $1.1 billion. Now they have this interest expense line. You'll get to the balance sheet here in a moment, and you'll see that Starbucks has a healthy amount of debt, not balanced off by a tech-like balance sheet of cash. And so you spent $140 million in the quarter servicing that debt. That impacted your net income and reduced it after you pay taxes to about $772 million. Last year, you were closer to $908 million. You flow down here to a balance sheet, and this is not Google, Microsoft, or Apple, that's for sure. We're spoiled looking at those companies on a regular basis. Your cash and cash equivalent, still $2.7 billion. But last year, you had 3.5, and that was even back in October. That was not even a year ago. So some cash has left the building. You come down here and you balance off with some long-term debt to the tune of over $15.5 billion. Last year, it was actually closer to 13.5. Let's come down here to cash flows. This is important. This is a 2-quarter number, so you're getting a 6-month view of cash flows. Company has large depreciation, has some non-lease or non-cash lease costs that get added back in, and you get your net cash provided by your operating activities here. Actually relatively strong year over year on a 6-month basis from $2.4 billion up to $2.9 billion, but you have to continue to build out those stores. And last year you spent $1 billion doing that. This year you spent $1.3 billion. You also made another $472 million in investments. So you chewed up about $1.2 billion of that there. You have to continue to serve this debt. One way they're doing it is just reissue new long-term debt to the tune of $2 billion in the quarter. They paid off about that much. You're continuing to pay cash dividends, since that is maybe one of the only reasons to hold this stock. You're getting a forward yield of 3.2%. If you've held this one like I have for a long time, your yield actually is quite a bit higher than that as you've experienced dividend reinvestment and growth there. And they continue to rebuy the stock, although they probably should have waited since shares are obviously taken a massive tumble since this announcement. This $1.3 billion they spent buying back the shares would have went a little bit further. So factor all that in, the cash flow you generate building out or running the business, the cash flow you burn through building out new stores and new investments, and the cash flow servicing debt, buying back the shares, and paying a dividend. You saw cash decrease by about $787 million just over the past 6 months at Starbucks. Now, from a technical perspective, we are at decision day. This is an area of support. Now, we did break through it during COVID. This is just such an extraordinary move that this stock made, and really the stock market made. You can almost ignore this type of move. This rarely ever happens. Needless to say, you have support at shares right here at 73. And here we are, decision day for Starbucks, right at $73. If you break through $73, the COVID lows and this consolidation period where a lot of us accumulated these shares, this is absolutely in play. So if you do, quote, buy the dip on Starbucks, one way to protect yourself is a stop loss. You would not want to break this area of support, probably at about the $69, maybe as low as the $68 level. You get below $68 on this one, the probability of going to $55, $58 is astronomically high, because when areas of support don't hold, it means the buyers just didn't step in and the sellers continue to materialize. You could argue more recently as well that we simply have not made a higher high on this stock in a while. So even if we do bounce off this $73 level, the upside potentially could only be back into the 90s. And if you believe we're heading into a recession here in the United States, unemployment is going to get materially worse. Well, these numbers at Starbucks certainly are not going to turn around anytime soon. I still like Starbucks, but boy, you are concerned. I don't think I'd run out and buy shares at this level. I'd wait until you see some level of support, some level of consolidation. I would have a stop loss set right about $68. And honestly, if you had a short-term pop and rebound in shares back up to 90, maybe I wouldn't sell my whole position, but I'd probably shave off a couple of shares just to lock into some profit, since this company clearly is at a transition point, clearly faces competition, and clearly needs to make some changes inside of its store from an operational standpoint just to turn things around. And without Howard Schultz there, not sure you have a lot of confidence that this management team is prepared to execute. Hopefully you enjoyed today's video. We'll be back again with more. Good luck with your investments.